welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Manish Lodha, Fund Manager Equity at Mahindra Manulife Mutual Fund. Welcome, Manish.
Thank you, Ruchira. Thanks a lot for having me on your show.
Now, let's start from where it all began for you. What was it like? What was it that drew you to equity investing? Was there a specific moment or experience or someone who influenced you?
So I go back to my school days. I was studying in Calcutta after my 10th, and stock exchange was just a stone's throw from my school. And many of my batchmates were, visiting stock exchange after the classes were over by 11 a.m. And it was in the early 90s or mid 90s, right? Markets were booming, and Calcutta, as usual, was a vibrant place for stock investors, passionate investors. So markets made me earn something, learn something sometimes, right? So it was going on when markets crashed in the mid 90s. So it was a great learning that things will not go like that. We need to learn, research. So I started reading magazines, newspapers, and I started getting passionate about stock investing. And it was a great interest that time. And I found a differentiated, approach when I could correlate stocks movement with the company fundamentals, and knowing about the management, and I started getting some more rewards by doing that. So they started all there. And I think then in college, then in my CA degree, more and more watching budgets, analyzing stocks, whatever money I had, putting into market. And so I found it interesting, and thought of, going further deep into that.
Manish, indeed, it's been a long journey for you. Started with BOC India, which is now called as Linde India. Then a short stint at Axis Bank. It was in corporate finance department.
Yeah.
And then working with the Kotak Mahindra Mutual Funds, and then insurance company. So over the period of these 2 decades, what has been the key learnings for you in the market?
So I think I had a varied career spanning last 24 years, starting from corporate finance function of a British MNC, with posting in one of the manufacturing locations, tough task. Then moving into lending function of Axis Bank, a short stint. Then after that, moving into debt fund management department of Kotak Mutual Fund as a gateway to enter into equity investing, because getting into equity from corporate was difficult, from bank to fixed income. Then within 1 year after joining Kotak, I moved into equity investment. Worked there as a research analyst for about close to 10 years in equity research department. And then in my pursuit to become a fund manager, got an outside role, so moved into Canara HSBC. So I think Linde India, 4 years experience is founding stone for my career. In my posting in Jamshedpur plant, I dealt with many entities, many people like, vendors, customers, trade unions, engineers, and sales employees. And, a lot of legacy works had to be done when I was deputed from head office to Jamshedpur plant, which was a quite challenging task, stepping out of my comfort zone in getting things done. At the same time, learning and growing as a person with great degree of humility and empathy. So I think those years created, a lot of ways to build my career as a person, as a team worker in my future organizations. Then I got this opportunity from Linde India to Axis Bank. It was a short stint in Kotak Mutual Fund. Again, exciting journey of 10 years. Showed me bull market of 2006-07, then bear market with the start of the next decade, right? So the companies which were darling of the market in 2006-07, nobody was giving them money, nobody was buying them. So I think market showed me, or taught me to see things beyond what a bull market is showing you. And secondly, when a sector analyst is facing a downturn, it's a great opportunity for him or her to own his or her research skills, because companies easily meet you, and you use the time to expand your knowledge base, to get better skills. And these things really pay off when the sector's time come, right? So the conviction levels are very high when you have done in-depth research in the downturn in the sector. And I still getting paid off from those times work in current bull market when the capex cycle is there. I was a capital goods analyst in the Kotak, infrastructure analyst, and now the time has come after 10-15 years to reap benefits from those sectors. So I think this was a great learning as an analyst, process orientation, going in depth into the models and business processes, analyzing managements, analyzing CEOs and CFOs, making your notes, and solidifying your grip into the company's fundamentals. So that was great experience. Then when I joined Canara HSBC Life Insurance as a fund manager, I was on the other side of the table in the fund management. So I think when you step out of the shoes of the analyst and enter into the chair of a fund manager, the way you look at things, the perspective changes, right? It imbibed me a lot of flexibility and agility in my approach towards looking at stocks and taking calls, where as an analyst it was difficult to take at that point in time. So I think it was a varied experience, giving me a solid foundation of in terms of behavioral approach, team working, process orientation, and various phases of the market. So learning like use the downturn in the cycle to strengthen your skill so that you are ready when the upturn comes.
All right. Now, moving on, how would you describe your investment philosophy and what kind of stocks or market conditions really get you excited and motivated?
So I think India is inherently a growth economy, and thus there is a reflection of growth market. And so I have been, a growth investor since beginning. And so growth and value are two sides of the same business. Something which was growth for last 10 years is value now, and vice versa. So either a compounder, long-term compounder with good growth, market share gain, or something which has not done well in last 10 years, but some fundamental assumption is changing in terms of the volume growth, or maybe some regulatory changes, or maybe the theme becoming relevant in the current context of the GDP growth rate. So we move into that. So and naturally, being integral part of the market, so I don't see it something like that it's a bull market or bear market, because then that will limit my abilities. I always try to see the right side of the market, whether it's a bull market or bear market, and position portfolios and think accordingly. So this has been the core philosophy, that every phase of the market gives you some learning, some opportunities. And since India is inherently a growth market, so we cannot lose focus on the growth. We have an investment process encompassing four things, which is growth, cash flow, management, and valuation. And as I said about growth in my previous answer, now coming to cash flows. So I think we have seen that company generating better cash flows, or management taking better capital allocation calls, get rewarded in the long term, as they do not depend on external capital for their growth, because external capital is not available all the times. There are favorable times when external capital is available. Valuation comes the last, but it's important. So I think if something is good, something is really appealing, that will remain pricey unless assumptions behind that is changing in terms of the growth or management or cash flows. So I think this is integral part of the investment process. Now, when we look at identifying opportunities or stocks, we look at a few things, like whether the industry to which the business is pertaining is growing, whether the management or that company has ability to gain market share over a period of time, backed by a good management, capable management, right? So at times, I keep saying that I rely on the management, buy management, not stocks, because if you are betting on a right set of management, it's their job to worry about downturn in the business or upturn or business challenges, right? So I think this has been our investment philosophy. And when we look at stocks, I think various opportunities comes at various point of time. And the sectors which are now in favor were not there in favor 10 years back, 15 years back. So keeping an eye on what's happening at the macro level and connecting the macro to a micro opportunity is something we focus on, and then creating the portfolio accordingly.
Manish, coming to the equity markets, which has rising relentlessly in the last few years, or we can say even last few weeks and months. According to you, what is driving this rally? Is it the investor sentiment or the strong fundamentals, or combination of both?
It's combination of both, right? I think let's take one by one. Stock fundamentals, by that we mean its earning growth rate or EPS growth rate. If I take last 3 years of rally in the market from, let's say, September 21 to now September 24, markets are up by little over 35% from 18,000 to 25,000 at Nifty level. So are the earnings. So earnings are up by, if I look back, earnings 1 year forward expectations were about 825 that time. Now today 1 year forward, I mean FY26 expectations are about 1300 or maybe slightly more than that. So on that level, I don't find markets very expensive. Yes, they are expensive because we are comparing a peak with the peak, but India is like oasis in the global desert, and because other parts of the global economy are either slowing down or have slowed down, and India is looking a big opportunity because of our demographics, our median age, and potential for India to become a third largest economy in next 5 to 7 years. So these things are keeping sentiments very high from a global investor point of view. From domestic investors point of view, sentiments are high because over the last 5 to 10 years, because of digitization and information availability, and maybe great work done by distributor community, mutual fund distributor community, and great work done by platforms like you, people have understood that if you are in the market for 5 years in an economy like India, you make money. So what used to happen earlier? Whenever market used to correct, people used to stop their SIPs or pull out money. Now in last 4 years, what we have seen that when markets are correcting, people put more money. They don't stop SIPs. So I think their temperament has become very strong towards investing, and awareness that in this kind of economy, if you are with the right set of investment partner, a right fund manager, or right fund house, right, it's a great opportunity to make money over the next 5 to 7 years.
Right now, Manish, valuations, especially in the mid and small cap segments, they look pretty stretched. You just mentioned that if something is good, it'll remain pricey. But do you think that these valuations are justified, or are we potentially heading toward a correction? Also, what could trigger such a correction in your view?
So, first part of your question about high valuations in the mid-small cap sector, I think it's a too general in my view, because mid-small cap as a category is becoming more and more relevant for the next leg of the economic growth rate. Yes, valuations are expensive, but I look at bottom-up basis, some sectors, some themes where largest companies are mid-small caps, and they will become larger in future. Those businesses become very relevant from next 5, 7 or 20 years GDP growth perspective. Their role has become more relevant now. For example, EMS, defense, entire EV ecosystem, in the NBFC space, entire capital marketplace, maybe exchanges, or maybe within the pharma CDMO exports, especially after US Biosecure Act, where they will be downsizing their imports from China and maybe importing more and more from other countries. So there are lots of such opportunities where the growth will be very high in next few years, and not only growth will be very high, the longevity of the growth is also very high. So the growth runway is looking good. So if I discount back, excess returns which are to be made in these companies or these themes over the next 5 to 7 years, then the valuations doesn't look very expensive. So better to look at from PEG angle than PE angle, right? And maybe some segment of the mid small cap is expensive, and on a weighted average basis, the entire mid small cap is looking expensive, right? If something is at 70-80 multiple and that is 20% of the market, then it inflates the entire basket's multiple by 5 to 7 notch, and that's the only difference I see.
Manish, coming to the specific to the funds like Mahindra Manulife, midcap and small cap, which has done phenomenally well in 2023 and even in 2024. So two things: what factors has led to the outperform of this fund, and which are the sectors or the stock call which has gone right, which has shown positive impactness on these funds?
I think performance is an outcome, and we got a great outcome in last 2 years. And difficult to assign a reason for that, but yeah, we stick to our core philosophy and processes. So if I can say that if I have to compromise with our process or returns in the short term, so not with process, maybe we will compromise with returns. So I think that's where the consistency in the performance can be ensured over a longer period of time frame. In the sectors which contributed to the alpha we generated, or maybe whatever performance we got, some of the sectors I can highlight are capital goods and uh, maybe entire EV ecosystem, some chemical companies. Telecom was a big contributor. Some of the pharma stocks, as pharma of late in last 1 year picked up again after 1.5, 2 years of downturn post COVID, right? So, and power sector was one big contributor, as power story in India is unfolding very nicely. There were no investments in the power sector in last decade, and now power demand is growing on three counts. One is, individual power consumption, household power consumption with rising per capita GDP, more and more usage of household things. And maybe, when we are expanding, on the backing of manufacturing led growth in our GDP, then you need more and more power. And third is emergence of AI and data centers. They consume a lot of power. And now, India wants data to be stored in India. So India will have lots of data centers which are power guzzlers. So I think these are some of the themes which helped us to get the outperformance and whatever we have now.
Is there any difference between managing large multi-cap kind of strategies compared to the small and mid-cap funds at the Mahindra and the fund house?
No, I think fund mandates are different in large cap or large mid vis-a-vis small and mid cap funds. And but even in the large and mid cap fund or large mid cap fund, we focus more on bottom of stock selection, where either the business is doing well or business is about to do well on the basis of long held fundamental assumption change. And since the entire focus is on bottom of stock selection, and there are core philosophies around growth, cash flow management, evaluation, so there's not much of difference. Yes, but small and mid cap calls for much more rigorous work, and maybe much more in-depth research, because large cap companies are well researched, but a small and mid cap company is not so well researched. So in-house abilities play a big role in that. And maybe well diversification of the portfolio is another angle which we need to put into mid and small cap.
Okay, and how does the sectoral selection come into play mid and small cap funds?
So in a small cap fund specifically, or in a multi-cap fund which I manage specifically, when there's a large allocation towards small and mid cap, the thought doesn't start from the sector first. The thought start with the businesses. So if I have a certain weight for a sector in my small cap fund, then it is not that I decided to go to that weight. It's a summation of stocks I bought. So we arrive at that weight. So largely it is in that way. Sometimes we look top down also in a small cap, right? So maybe when we looked into metal sector in the for the small cap fund, so there was a thought that metal sector is going to do well. So let's buy some mining companies or some converters. So sometimes it's a blend of top down and bottom up both, but largely in a small cap or mid cap fund, it's bottom up call which goes into making the portfolio.
Right. Now, you mentioned some contributors to the outperformance of your mid cap and small cap fund, but finding value in the mid and small cap space isn't really easy. So are there any specific sectors or industry where, you currently see untapped potential?
So one thing which comes to my mind, and where, we have been working for last 2-3 months, is chemical sector. So chemical sector did extremely well in 2021. Then, China came back after extended COVID period, and China started, flooding the global market with basic chemicals, and prices came down. So the sector went through a downturn of profitability in 2020 to 23, but now things are easing out, and on a bottom up basis we are seeing some opportunities where prices are recovering, volumes are growing. So that's one sector where there could be opportunities available in mid small cap space. Second is, which I mentioned earlier also, that when it comes to pharma exports, CDMO players, so that's really China plus one, where US Biosecure Act is likely to play a big role in giving more and more business to pharma companies outside China. So these are the two things, and thirdly, maybe small and mid cap companies across around the EV ecosystem, in terms of the battery plays or in terms of some other plays which are ancillary to EVs or autos, or which have an overlap with defense, industrial, and auto, all three. So these three pockets still look good.
Manish, if we look at the portfolio of multi-cap fund and the large and the mid-cap fund, you have been overweight on IT and metal sector and underweight on the financials. So what's the strategy behind this allocations?
So IT sector, I think after 21 rally, it went into some sort of struggle in terms of higher attrition, very high wage cost. At the same time, because of Ukraine-Russia war, there was slowdown in the Europe and US, right? And valuations were very high. So sector went through a time correction in last 2 years. With the start of CY24, we witnessed that downgrades are behind. There were no downgrades in March 24 quarter, and in fact there were upgrades in the June 24 quarter. Attrition was at all-time low, and wage hikes were all-time low, which was giving some conviction of recovery into margins, recovery of margins. And at the same time, discretionary spends in the US have not happened in last 2 years. Though there is a risk of mild recession in the US, but I think Indian IT companies are well poised to have a steady revenue growth rate, or maybe pick up in the revenue growth rate vis-a-vis last 2 years, and uptick in the margins. And at the same time, we saw that other segments of the markets are very expensive, or maybe some excesses are being created in those segments. So IT came with a defensive bet also. So these were reasons to go overweight in the IT sector in last 2-3 months. Another is power sector. We are overweight. So power, again, the story of power is unfolding in last 2-3 years very nicely, where India needs to double the power capacity in next 5 years, and again I think double the power capacity in 10 years after those 5 years, right? And renewables can at best be complementary to India's power situation, but not as an alternative to India's power situation in next 1 decade or so. So we are positive on both fossil fuel and renewable power. And as I said, there are three drivers to the power demand: higher per capita GDP leading to higher appliances or household durables, and maybe better use of air conditioning, which is a power guzzler. Second is when we have manufacturing led growth, that means more power. And third is emergence of AI and data center, where power consumption is very high compared to ordinary uses. And valuations were favorable for power companies, still favorable compared to some other sections of the market, right? So the power sector didn't give any return in last 15 years, and by that it was quite underowned. Still, ownership is not very high in the power sector. In view of the fundamentals, it is going to enjoy in next few years. Thirdly, I think on financials, I think we are leaving behind peak interest rates. So any rate cut over next 1 quarter, 2 quarter, or 3 quarters is likely to put some pressure on NIMs of the banks. In NPA front, we have had the best of the asset recovery and lower credit cost in last 2-3 years. So from here on, if things can change, then I am skeptical about spike in NPA from farm loans, or maybe with some lag, maybe retail loans, if economy has to face a temporary downturn. So I think though valuations are reasonable, they are very favorable for banking system, but there is a risk of disappointment in earnings on the back of rising rates, if they were to rise in future, falling NIMs, and banks are well owned also in the market.
Right now, when it comes to your aggressive hybrid fund, it seems like getting the sector picks right has been a key factor in your fund's consistent outperformance over the past 5 years. So when it comes to deciding whether to be overweight or underweight in certain sectors, what factors do you consider? Do you walk us through the thought process?
So as far as sector underweights, overweights are there, I think there is no differentiated thought for aggressive hybrid fund. It's the same thinking which we apply to other funds. Let's say if in my multi-cap fund, or in the fund house in a mid-cap fund or a large mid-cap fund, we are extremely bullish on one sector, then that fund will be overweight. That sector will be overweight in a hybrid fund, whether aggressive hybrid or a BAF or something else, right? So I think that's the thing, and in aggressive hybrid fund we have a leeway of booking profit and increasing the non-equity part of the fund when the markets are high, and we book profits. At the same time, while booking profit, at the same time we need not buy again or replace with another stock, and can have a leeway to wait for some correction in the market. So equity allocation moves in a tight range in that aggressive hybrid fund, which has also benefited the fund to do well over a period of time.
Manish, how do you approach the position sizing in this of your holdings? Because it looks like you tend to spread your bet across the multiple stocks within a sector rather than having a concentrated bet on few stocks within a sector. So, is that a deliberate strategy, and why you're adopting this strategy?
So this is more true for small and mid caps. And we have a conscious strategy of not going above 2.5% in a small cap stock or 3.5% in a mid cap stock at the point of buying. So I think in current market environment, when many themes are doing well, many stocks are doing well, and new ideas keep coming every month. So I think it's good strategy to diversify rather than concentrate, and and have various flavors in the portfolio. And maybe mid small cap fund, we want to accommodate maybe sometimes a good compounder, sometimes stock likely to do well based on some fundamental assumption changes. And I think markets were facing a lot of sector rotation in last few years. When very frequent sector rotations happen, then you want to sell something from one sector and buy something from another sector, then there is an overlap, because you don't exit one stock in one day and entirely, and buy another stock entirely the next day. So while I continue to sell something for few days or maybe few months, and continue to buy something new for few days, few weeks, or few months, you find both the stocks as part of the portfolio. And in quick sector rotation market, I think the number of stocks at times look higher than what I actually want to own, because I am in entry mode in some stocks, I am in exit mode in some stocks.
So, is this a deliberate strategy, or will you change when the markets has different way going forward?
No material change is expected, because even if there is no such sharp or quick sector rotation, then also maybe against 60 stocks in one fund we will be 50-55. It will not change materially, because diversification is something which is an opportunity also in Indian market, and to face the volatility, and to have a stability in the portfolio.
Okay, and same goes with the even with the aggressive hybrid. You do the
Yes,
same
same
thing.
goes with the aggressive hybrid fund also.
The PE ratio trend for the mid cap fund suggests that you might be shifting from a focus on growth stocks to a more blended approach, incorporating both growth and value stocks. So, is that observation accurate?
So that observation is accurate, as we from time to time we book profits from some segments of the market and move into another segment of the market. And let's say we had market where a lot of high P stocks did very well in last 2-3 years, and maybe it's good to book profit. And if a fund manager is finding value in some other pockets which are looking cheap, or where the growth potential is there at a reasonable valuation, so that shift normally happens. So it's not by design, it's more by bottom up sector selection, stock selection, or maybe moving out of one set of stocks and sector to another set of stocks or sector where the PEs are lower.
Particularly to the mid cap fund, we have noticed that there has been a generating a lot of its return from the large cap part of the portfolio, with the mid and small cap segment slightly overvalued. How do you plan to manage this fund going forward?
No, I think this will again depend on available opportunities. So, for example, we bought last year around same time one of the large mining stock, where the stock didn't move in 10 years, but something was changing. So it was a good opportunity. So it's not that we wanted to buy a large cap name, but we bought a alpha idea, which happened to be a large cap. So I think it's more to do with the future opportunities and alpha generation abilities in the market from various stocks. However, we need to go by the mandate, which is 65% minimum mid cap in a mid cap fund, or maybe 65% minimum small cap in a small cap fund. But of the balance 35%, which is the flexi portion, will be driven by what are the market opportunities and what are the alpha ideas available in the market, good companies, and companies offering good growth and upside.
And in this fund, it also seems like you've been making some tactical allocations alongside your longer term holdings. So how much of the portfolio is dedicated to these tactical positions?
So even if there is a tactical position, the view on that stock has to be positive. And maybe by tactical, we mean that over a period of 12 months, you make money, and maybe you want to wait for 3-6 months. You are expecting an event, or maybe some sort of re-rating in the business based on the future growth rate changes. But maximum 5, 10, or at times 15% allocation can go into such tactical calls, not much, right?
Okay. All right. Well, with that, it's time for us to wrap up this chat. Thank you, Manish, for taking the time and, interacting with us. It was great having you.
Thank you so much, Ruchira. Thanks, Chirag.
Thank you.